Now, what a diversified portfolio means is that it includes different asset classes, right? Like what we spoke about. It incorporates various sectors within asset classes, right? Like, for example, when you're buying, say, different securities in the stock market, you're not just focused on buying, say, tech stocks, but you're also focused on buying, say, stocks from the retail segment, from, say, from manufacturing segment, right? The other thing would be to also include domestic international investments, like we saw in the last 2 days, how although markets were interconnected, but the markets did not react in the same way, uh, like different markets, right? Like for example, over the last, say, 2 odd days, we saw that the US market wasn't doing that great. But if you had looked at, say, the Hong Kong market, it was not as impacted as the US market was, right? So you have to include both domestic and international investments, and your aim should always have, or should always be, on how to balance risk and reward. And that will ultimately be dependent on what your risk tolerance and goals are. Uh, so one of the main principles of this, of building a diversified portfolio, and one that I have always followed, is to not put all your eggs in one basket. It's to just diversify. It's to just like build a portfolio with as much exposure to as many different things as you can, because until it's doomsday, I don't think there will come a day when everything is going down at the same time and everything is being affected at the same time. Diversification also like kind of occurs at multiple levels within the asset allocation framework, right? So it can be across asset class, within asset class, and among individual securities, like something that we spoke about now, right? So let's think about why we thought about diversification and what's the importance of asset allocation, right? Like, I think we have discussed this in multiple times in the last 10 weeks, that asset allocation is basically dividing your investments among different asset categories, right? And the key aspects of them would be to, you know, it's considered one of the most critical decisions when you are constructing a portfolio. Kind of it determines what the overall portfolio risk would look like, what the return would look like, and it absolutely depends on what your risk profile looks like, and what your goals look like, and what your timeline looks like. So I would say a portfolio would be fairly different for someone who's looking to stay in the market for 5 years and wants a return of 20%, versus someone who's gonna be in the market for 2 years and wants a return of, say, 35%. Very two different investors, very two different portfolio management. But one of the things that you've got to ask yourself is, what are the benefits of asset allocation, right? The first is, of course, risk management, right? Different asset classes have different risks and perform different in different market conditions. The second would be a potential for much higher returns than you could have got, right? Again, example is the last 2 days. If you were only invested in the stock market, you definitely got a hammering because the entire US stock market was down, right? Whereas the bond market wasn't as such. So if you were diversified within the bond market and the stock market, you could have done much better than someone who was only into, say, buying stocks, right? And I think the last thing would be why you want a portfolio, and the benefits of asset allocation is the alignment with the investor's goals, right? It matches investment strategy with what's your time horizon, what's your risk tolerance, and what's your goal. So there has been literally various amounts of research in this field, right? And some of the research findings were that that asset allocation explains 90% or more of a portfolio's performance variability over time. And proper asset allocation can potentially lead to more consistent long-term investment results. So it's not something that I am kind of preaching, or it's not something that I'm kind of trying to drill in, but it's also backed by very good research, which has been studied over a long period of time to tell you that yes, this is absolutely the right way forward. So again, coming back to the three key things which determine asset allocation, right? What's your risk, what's your time horizon, and what's your goal? So when we look at risk tolerance, right? I would say, what does it mean? It means the degree of variability in investment returns that you as an investor is willing to work with, right? Like, for example, um, I'm not, if someone can take up huge amounts of risk, the way their portfolio would look like, the way their assets would look like is completely different from someone who might not be able to take so much risk. And it totally depends on who you are as a person, and it totally depends on who you are as an investor, right? So what are the few assessment methods, right? So one of the few assessment methods are 1 minute. One of the few assessment methods where are like having questionnaires, building psychological profiling, right? What are the analysis of past investment behaviors look like, right? And the key point that I'm trying to drive with risk tolerance is it's not bad to have, say, a lower or a higher risk tolerance. Uh, a lower risk tolerance generally means that a higher allocation to less volatile assets, right? And a higher risk tolerance just means that you have a tolerance um, to go in for the big hits. Because think about it, in the market, risk is tied with returns. The higher the risk, the higher the returns. But it depends on the investor whether they can take that much amount of risk, because it is also true that higher the risk, higher the probability that all your money would go down the drain. So you have to understand who you are as an investor and take it from there. The second thing would be time horizon. The expected length of time you as an investor would want to be in the market, right? So normally there are three types of investors when it comes to time horizon: short-term investors, medium-term, and long-term. So short-term would be someone who has less than 3 years, medium-term would be 3 to 10 years, and long-term would be over 10 years. And longer time horizons allow for higher allocations to much growth-oriented assets like the stock market, right? Like, for example, think about index funds, right? Over time, the index is going to go higher. So there's not a great deal of rocket science in this, right? Like, if you just mirror the index over, say, the next 20 years, the index will grow higher than what it is today. Like something like, say, for example, uh, the New York Stock Exchange, the index NYSE is higher than what it was in 2010. Absolutely, right? Because over time, spend is going to increase. Over time, the value of stocks is going to increase. And that's why the index is just going to go up and up and up. And lastly, I think it depends, the asset allocation mightly depends on financial goals. Like, what are you building towards, right? Like, are you building towards retirement? Are you building towards a home purchase? Or are you building towards wealth accumulation? What is the goal that you're building towards? And it is important because the goal will influence your risk tolerance and your time horizon, right? Like, for example, if I'm building towards my retirement and I know that I have the next, say, 30 odd years to build my portfolio, I I would go for like things which will grow with time and has lower risk. Whereas if I think that I need that money in the next 3 years because I want to do, say, an MBA, I think I need to take more risk because the time horizon is less. and my goal is much bigger, right? And think about it. You might have multiple goals which may require different asset allocations within a single portfolio, right? Like, for example, your goal could be uh, low risk, high return, right? So how would you, so you'd have to kind of nullify your stocks in a way where some of it is high risk, high return, some of it is low risk, low return. So together it becomes, it just meets the goal that you are working towards. And that becomes like truly thing that you are gunning for. One, why is this not? Yep. So there are three kinds of models, right? When you think about asset allocation, there is an aggressive model, then there's a moderate model, and then there's a conservative model, right? Like I said, when you are like when you have the time horizon, it's different. When you don't have the time horizon, it's different. And when you are very much dependent on the investments that you have made for your day-to-day activities, it's a very different profile, right? So how does a conservative model look like? So a typical investor profile would be near retirement or in retirement. So they would have low risk tolerance because they need that money to build out their day-to-day activities. And a sample allocation would be 20 to 30% in stocks, say around 50 to 60% in bonds, 10 to 20% in cash, and around 0 to 10% in alternative investments, which might be like even crypto or any other investments. The primary goal of these kind of people, the primary goal of the conservative model is to preserve your capital and to have a monthly income which would satisfy your day-to-day activities. And then comes a moderate model where the typical investor profile is a middle-aged a middle-aged person with a moderate risk tolerance with a medium to long-term horizon. And the sample allocation would look like 40 to 60% stocks with a 30 to 35% bonds, 5 to 15% cash, and 0 to 15% in alternative investments. So it's a healthy balance between growth and income, which is because you are still some years out of retirement, maybe around say 5 to 10. So you have an income, so you don't need a lot of money to flow in right now. All you need is to save and grow your money at this point of time. And then there's the aggressive model. These are like young people, young folks like you and me with a high risk tolerance and a long-term horizon, because we know that even if we go bust, we have a long time to recoup our investments, right? And the sample allocation for us would look like around 70 to 80% in stocks, around 10 to 20% in bonds, 0 to 10% in cash, and 0 to 20% in, say, alternative investments, which can be which can be crypto, which can be ESG bonds and different things. And our primary goal here, at least my primary goal would be to have maximum long-term growth, because I'm like, say, 30, 35 years away from retirement. So I know that in the next 35 years, I need to grow my money in a way that when I hit retirement, I can become a conservative investor. The next thing which I thought that you guys should know about is the importance of measuring portfolio performance, because you have a portfolio and that is great. But how would you be measuring the performance of your portfolio, right? And the importance of measuring portfolio is in like goal achievement, right? Are you tracking progress towards financial objectives? Are you evaluating effectiveness of those chosen strategies, right? Accountability, like, are you assessing yourself as a fund manager, or if you have put your money into a mutual fund, are you assessing the manager on their performance, right? The third would be informed decision making. So a data-driven portfolio would help you to make adjustments within the portfolio that would kind of help you to kind of balance it out and get a much better return than you could have normally got. and risk management, right? Like what your risk appetite is today might not be what your risk appetite is tomorrow. So measuring portfolio performance would also help you adjust your risk tolerances over time and ensure that you have the appropriate risk levels for who you are at that point of time. Think about relative performance. You compare against benchmarks, you compare against peers, understand market context, and then, of course, the thing that every one of us strive for, continuous improvement in the performance of our portfolios. So I would say the key takeaway from this slide is that regular performance measurement is crucial. It's absolutely necessary for optimizing portfolio management and achieving long-term financial success. I think there's no other way you could do that. And I think it's going to be game changer if you analyze the portfolio performance over time. So when I say like, manage your portfolio, analyze your portfolio performance, the question that some of you guys would have, how do I do that? Like, what are the metrics look like? Like, what am I benchmarking against, right? So let's talk about that. Like a few of the key performance metrics, which like you should be able to track or you should be benchmarking against are number one, total return, right? What's the actual rate of return over a given period of time? Like, what's the capital appreciation look like? Like, say, for example, you went in with $10,000. What does the total money look like at this point in time? Does the $10,000 look like $9,000, or does the $10,000 look like an $11,000 right now? How much income have you had? Because your investments would give you dividends, right? It would give you interest, right? So what's the income looks like? And you could, of course, look at the formula that is there to understand how you would be able to calculate total returns. So which is basically nothing but end value minus initial value plus income divided by initial value, which is basically, say, you went into the market with $10,000 and right now it's around $11,000. So your end value is $11,000. Your initial value is $10,000. And say you had a dividend income of like, I don't know, maybe $50, $100. So that's your income divided by 10,000, which was your initial value. Now this is give you your total return percentage, which is basically an understanding of what's my returns looks like. And then there's, of course, the annualized return, right? Because just like people who are in the stock market analysis game, you guys do not have an entire year to play this, right? So you have a very and Jim, you had like maybe a couple of months to make investments. So then you could also think about what does annualized return look like for me, right? You could express your total return as an annual percentage. It enables you to compare investments held across different durations, right? Like say, some investments you'd be in it for like say a couple of years, and then some investments you'd be in it for 3 months or 2 months, right? But when you do it in annualized returns, you would figure out, okay, this investment. So it's basically annualized returns is a way to do an apples to apple comparison, which is very important. And the formula would be 1 plus total return to the power 365 by the number of days minus 1, which will totally give you the annualized return for every investment that you have held and kind of empower you to have an apples to apple comparison across all your investments. I think the key takeaway from this slide would be that both the metrics are essential and kind of helps you to get an accurate performance evaluation and comparison. It offers you insights into how your investment success looks like and kind of helps you in decision making, right? Like, for example, say tomorrow you get a question, right? Like, for example, you have been holding on to say Google stock for like 2 years, and you have had Amazon stock for 2 months, right? And the question that comes in your mind is you need some liquidity, so you want to sell either one of them, right? So which one should you sell? Now, both have very different time horizons. So how do you know which one performed better, right? So these are the metrics which would also tell you that, okay, say Amazon performed better than Google, or Google performed better than Amazon. That would also help you to know which investment of yours is performing better. So which one you would like to move out of, or which one you'd like to stay in. That kind of helps you with informed decision making. There are a few other ratios that I personally feel like you could track. One is the Sharpe ratio. It kind of measures excess return per unit of total risk. So, like, Sharpe ratio is why it's beautiful is it kind of so somewhere you can have this question. Okay, I want to know for how much more risk, what's the how much more of return am I getting, right? And Sharpe ratio can tell you that, right? The formula is right there. What's the portfolio return minus the risk-free rate divided by the portfolio standard deviation? So a higher ratio indicates better risk-adjusted performance, right? It is quite widely used for comparing portfolios with different risk profiles, right? Like, for example, stocks versus bonds, for example, real estate versus stocks. Then we also have the trainer ratio, which it's very similar to the Sharpe ratio, but uses systematic risk instead of the total risk. So the formula for that is portfolio return minus risk-free rate divided by portfolio beta. It's useful for well-diversified portfolios because it assumes unsystematic risk and that has been diversified away. And the last thing that we could look at, I know these are a bit tough, and that's why I would say that you could more focus on the earlier slide, which is total return and annualized return. And like only if you want to go deeper and get into uh, some uh, some difficult math, you could come into these ratios. I think the last one is to also look at Jensen's alpha. It measures excess return over the expected return. So the formula is portfolio return minus the risk-free rate plus beta multiplied by market return minus risk-free rate. Uh, you'd actually get all of these. Like it's just substitution. You'd get every one of these numbers. You just have to put it in, and that would give you the Jensen's alpha. A positive alpha indicates outperformance. It helps evaluate a portfolio manager's skills. So kind of Jensen's alpha tells you if your portfolio is outperforming or it's underperforming. So I think these measures provide good comprehensive way to measure performance by considering risk, and kind of enables you to have a better comparison across different investment strategies, different market conditions, different risk-free rates. It also helps you to kind of think about how your investments are performing in different geographies, because like say, for example, the risk-free rate of Japan is much different than the risk-free rate in the US. So yeah, it kind of tells you a lot about the different about how your investments are doing, not only in different asset classes, but also in different geographies. I think the other thing that I wanted you guys to to learn is how to benchmark, and this is very important because benchmarking nothing but a standard for measuring performance of securities, funds, or even managers or fund managers. And the characteristics of a good benchmark is like, is it appropriate to strategy? It's measurable and unambiguous, right? Accountable and investable. So it's more like things like, what am I benchmarking myself against? Like, for example, say you have a portfolio, right? Normally what people do, and you will see, is they benchmark against one of the market indices, right? Like, okay, the S&P 500 returned 9%, whereas the fund did 11%, which means that we returned more than what the normal average market returned, right? So one of a few types of benchmarking are against market indices, style indices, peer group averages, absolute return targets, and of course, then you can build your own blended custom benchmarks as in how you see fit. But one of the things is, how do you select what you want to benchmark against? So I think a few things to keep in mind would be asset class alignment, geographic focus, market capitalization, investment style, sector composition, and risk profile. So when I say selection factors, I would say, like, for example, if you are only investing into the tech world, uh, benchmarking yourself against the S&P 500 might not be the right way to think about it, because when you look at tech stocks, they have always been doing better than the S&P 500, right? Like, they have performed way better, at least over the last 1 year, right? So, so it can give you false sense of confidence, thinking, oh, the tech world is, I'm doing so better. Whereas you might not be doing better, because the tech world is itself doing better. So everyone else is doing better. So you need to have an understanding of how and who, with against what you want to benchmark. I think the common mistakes that I see are mismatched strategy, frequent changes, and overly broad or narrow selection. Like, um, say if you want to benchmark your investment in Amazon, uh, yeah, you cannot just pull up another e-commerce company and benchmark against them, right? You have to go a little bit broader than that. So I would say, yeah, don't go overly broad or overly narrow, but look at sectoral focus, look at your asset class alignment, and look at the geographic focus, because the tech world in US is performing very different from the tech world in, say, Japan, or even, say, the tech world in London. So think about all of these stuff before you choose which benchmark uh, to 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 bench against, and choose. And I would say choose benchmarks that closely align with investment strategy and portfolio characteristic, which would give you a much better, meaningful performance comparison than anything else. So let's look at why should we benchmark? Like, what is the importance of benchmarking? I think the importance of benchmarking is to it gives you a context for evaluating investment performances, right? I think benchmarks serve as a reference point, enabling, like, investors to see how the success of their investment strategies look like. I think when you compare portfolio returns to benchmarks, investors, they can assess whether the investments are performing well or not. Second would be to set realistic expectation for returns, right? Like, for example, uh, benchmarks will help investors understand what the typical market performance look like, which would help you to set achievable return targets, right? It would kind of feed you to have realistic expectations, and will prevent disappointment, and would help you to take better investment decisions. The third would be to identify areas for improvement in the investment process. So benchmarking would tell you that you are underperforming, and then they would guide you as investors to see where you're underperforming and why you're underperforming, and that would refine your strategies. And I think it kind of improves your risk management, uh, and just makes you a better investor. And I think lastly, I think it facilitates communication with stakeholders and portfolio performance, right? Like, for example, so if someone is a layman, like, say, someone based out of, like, rural US, who doesn't understand the finance world as much, how they know whether their money has performed better or not, whether their investments are performing better or not. So these benchmarks provide a platform for, I think, discussing performance with your clients, with your advisors, and other stakeholders in the fund or the portfolio, right? And I think that's why benchmarking is absolutely very important in portfolio management. And that's pretty much it. I think, yes, that was basically all about portfolio management.